In this video, we're going to be breaking down how the Federal Reserve's recent interest rate cut affects your money, the economy, and the housing market, and why it matters for anyone with a mortgage, car loan, or debt as well. The Federal Reserve just cut interest rates for the first time in 2025, and the market loved it. We even saw record highs as well. And now, the Fed is hinting that there might be more cuts before the year ends. I waited a couple of days to make this video because I wanted to see how the markets were reacting. And here's the thing, you need to understand that interest rate cuts are not just about getting a cheaper mortgage or getting a cheaper car loan. They have big direct impacts on the economy and your money as well. So if you got debts, a mortgage, or thinking about taking out a loan, then this video is for you. The Federal Reserve, or our central bank, controls interest rates and can create money as well. They have a dual mandate, which basically means that they want two things: a strong economy with maximum employment and stable prices with low inflation. Until recently, the Fed was hesitant about cutting rates, right? They were worried that tariffs can make inflation worse, and they thought that the job market didn't really need any help. But now, the situation has flipped for three main reasons: bad job numbers, more certainty around tariffs, and stable consumer spending. Let's break it down. First, jobs. In August, the US added fewer jobs than expected. And on top of that, the previous month's job numbers were revised down, showing that the job market has been weaker than we thought. The Fed is reacting to that. And secondly, we have tariffs. Earlier in the year, the Fed didn't want to cut rates because tariffs created uncertainty. And now, with new tariff deals in place, they feel more confident that cutting rates will not spark inflation. And thirdly, we have spending. Americans are still spending money despite concerns about jobs, inflation, and tariffs. This matters because spending drives the economy. The more people that are spending money, the more money is circulating, and the more jobs are created, and the more the economy grows. And here's a key point: the largest spender in the US economy is not you or me. It is the government, right? And the government is also the biggest borrower as well. With $37 trillion in debt, the US borrows money from individuals, foreign countries, and the Fed, which creates money for them to lend. Lower interest rates impact both individuals and the government. For homeowners, refinancing at lower rates can reduce your payments or allow cash out options, which is going to put more money into your hands for you to spend. For the government, lower rates means cheaper debt payments and more room to borrow and stimulate the economy. But here's the catch: this can also fuel inflation. Our dollars are not backed by gold or silver. They are backed by a simple promise. So when more money is created and spent, prices can rise as well. Wall Street loves rate cuts because they tend to increase asset prices and benefit investors as well. President Trump has pushed for lower rates to make mortgages cheaper and allow the government to borrow more money. That is going to stimulate the economy, but it's also going to make financially savvy investors richer, while the average consumer is going to feel the pinch. Interest rate cuts are not going to automatically make your mortgage and credit cards or your auto loan cheaper, right? But they're going to give banks the flexibility to lower rates for borrowers. And in today's housing and car market, that flexibility matters a lot. Home prices have risen 50% over the last 5 years alone, and mortgage rates have jumped from 3% to 5%. So when the Fed cuts rates, refinancing is going to surge. Homeowners may lower their monthly payments or pull cash out of their equity. That cash gets spent on renovations, vacations, or other purchases, which feeds back into the economy. But here's the bigger picture. Lower rates help those who know how to use them, like investors and financially savvy people. For everybody else, inflation is going to make life more expensive. Even your high-yield savings account is going to earn less money. Understanding this system is key. Every single dollar you spend isn't just going to vanish. It flows into businesses and then to your investors. So if you want to grow wealth in this economy, you need to think like an investor and not just like a consumer. If this video helped you make sense of the Fed moves and what it means for your money, then share it with a friend, family member, or fellow investor. And make sure to subscribe for more updates for the economy, interest rates, and how they affect your wallet. And always remember that the best time to invest in yourself was yesterday. The second best time is now. You got this.